The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance.
There you have it. The Fed firing the starting gun, opting for a bumper half-point rate cut as policymakers set their sights on just another 50 basis points worth of easing this year. Well, it was pretty volatile, albeit in a tight-ish range in US stocks. Wall Street closed lower, despite the Dow and the S&P 500 initially jumping to fresh all-time highs, whilst Asian equities see strong gains post-Fed.
Not out of the woods yet. Bridgewater Associates founder Ray Dalio warns of soaring US debt levels, telling CNBC the Fed faces tough choices ahead.
The challenge of the Federal Reserve or any central bank is to keep interest rates high enough that they're good for the creditor while keeping them not so high that they're problematic for the debtor.
Spanish renewable energy giant Iberdrola opens a new €2.4 billion offshore wind farm in France, telling CNBC exclusively the investment is critical.
Without grid, you cannot already have access to electricity required. That's why countries like Britain, United States, are already pushing us to invest more and more in transmission and more in distribution.
More central bank action for you, this time out of the UK as bond selling comes to the fore. The Bank of England, well, that gets set to deliver its latest rates decision with a possible quantitative tightening expansion on the cards.
A very good morning to all of you. Well, I don't know about you lot out there, but with me, it's palpable relief. You know what I'm talking about, Karen Cho. Good morning to you.
Good morning.
Palpable relief that we finally got it over and done with. We can stop speculating, and now we can move on a little bit as well, because the Fed has finally started cutting rates. And it's about, to my mind, about a year later than some people on Wall Street initially said they would. They've gone for 50, and the juggling act, which I think actually Jay Powell did rather beautifully in his announcement press conference, was juggling, saying we've gone 50, which previously has heightened concerns about it being a crisis, because when they've gone 50 at the first part of a rate cutting cycle previously, it's normally because there's a crisis on the agenda. But what he did is, and that's probably where the market came off, is he said, no, we've gone 50, but there's no crisis.
Well, let's just talk about some of those expectations in the marketplace, because you're right, this year it's been a moving feast in terms of what some of the big houses thought in terms of those rate cuts. But that just goes to the story of the uncertainty in the data. And even Jay Powell himself was uncertain about a couple of months ago, back in July, had really effectively ruled out a 50 basis point rate cut. That was not really on the agenda. Here we are. He's having to carefully communicate why 50 is now the size of the cut, that it's not an emergency cut, but it's still a jumbo-sized reduction. So I think there was a lot in his messaging yesterday. Clearly the labour market in focus now, laser-like attention as we've stepped away from the Volcker years of trying to tame inflation to some sort of Greenspan-esque era where there's a soft landing, and Jay Powell's very much trying to land this beast.
But they're not going to land it. So they're not landing anytime soon. They're not landing on the inflation at target this year, next year. In fact, they don't expect to hit inflation target, I understand, until sometime in 2026. So there's a lot still in there. You know, the PCE, they don't expect to hit their PCE target until 2026. That's a lot of faith in your ability to land it and avoid a recession at the same time.
What's 0.1% between friends? I mean, 2.1% is where they see the PCE by the end of 2025. So that's somewhat of a rounding error. Close enough.
Okay, well, if you were mutual pedanticism this morning, you're saying the end of 2025. Ergo, the end of 2025 equals to me the start of 2026.
Between
but then
economists,
we're splitting hairs, I know.
But between economists, 0.1% is seen as a round.
Economists, don't talk to me about economists. The Bloomberg survey in advance of this had 113 economists, of which only 9 called for 50 basis points. Don't tell me the economists know anything.
Because it's unusual. This is an unusual moment in history. And if you've ever studied any form of economics, you know the uncertainty going into this decision, the fact that a jumbo-sized rate reduction has been used not in a crisis situation. I think that was the problem economists were struggling with. How would we get to that type of weapon or tool being used in this type of scenario? And J-Power reached for that tool.
The Federal Reserve, believe it or not, has cut its benchmark interest rate by 50 basis points, we may have mentioned, leaving it in a range of 4.75 to 5%. In its policy statement, the central bank said it had greater confidence that inflation is moving sustainably to target, albeit by the end of 2025, the start of 2026, and said inflation and labour market risks are now roughly in balance. The move is the Fed's first rate cut since March 2020 and comes after over a year of holding rates at their highest level since 2001, I beg pardon. Right, speaking after the decision, Fed Chair Jerome Powell said policymakers don't think they are behind the curve.
You'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time.
Michelle Bowman was the sole dissenter on the decision, instead backing a smaller 25 basis point cut. The first time a Fed governor has actually dissented on the central bank's decision since 2005. It's funny, isn't it? We get that all the time over here at the MPC. There were also signs of an opinion split in the Fed's dot plot projections. But again, kind of expect that. You kind of everyone's saying exactly the same dot plot going out for 2 years. But anyway, 9 policymakers said they expected 75 basis points or less of rate cuts this year, including the September, whilst 10 said they saw a full percentage point or more. Now, the median forecast suggested 50 basis points of cuts in the final 2 meetings of this year. I should say that's in its entirety rather than each meeting. And another 100 basis points of easing in 2025.
Well, let's talk about some of those economic projections we were just discussing. They were released alongside the decision and showed a more optimistic outlook for inflation, which policymakers now see at 2.1% next year, down from 2.3% forecast in June. Policymakers weakened their outlook for the labour market, with unemployment now expected to hit 4.4% this year, up from the 4% seen in the last set of forecasts. In his press release, Chair Jerome Powell was optimistic on the economic outlook.
The U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape.
Bridgewater Associates founder Ray Dalio spoke to CNBC after the decision, saying rising debt levels, mostly at sovereign level, let's be brutally honest, rising debt levels will have an impact on the Fed's decision making.
The economy now is in relative equilibrium at the moment, but there's an enormous amount of debt that needs to be rolled over and also sold, new debt created by the government. And there's the challenge of the Federal Reserve or any central bank is to keep interest rates high enough that they're good for the creditor while keeping them not so high that they're problematic for the debtor. And when you have large amounts of debt assets and debt liabilities, one man's assets is another man's liabilities, that balancing act becomes difficult.
Matt Orton is Chief Market Strategist at Raymond James Investment Management. Matt, thank you so much indeed for joining us. I think the governor of the Federal Reserve and the Fed did rather well yesterday. They moved quite brutally, but they convinced everyone there's no crisis. But what does that mean for our viewers' portfolios?
Hey, good morning, Steve. Great to see you. And I fully agree. I think this was absolutely a vote for the dual mandate. It's showing that the Fed has been successful thus far in bringing down inflation. And now we've got to be able to stick the soft landing. So when you look at what that actually means then for investor portfolios, one of the biggest themes I've been talking to our clients about really over the past 3-4 months has been this idea of leaning into broadening markets. So we know that markets are finally starting to broaden out. We've seen earnings breadth increase over the past couple of quarters. That's finally been translating into more increase in price breadth. And I think this move and the fact that we finally started this cutting cycle, I think it signals that this market breadth, the fact that the economy is in a good enough place to continue moving forward, I think that's going to continue to expand. So I've been suggesting looking into more cyclical parts of the market, like industrials, certain parts of real estate, and also more rate sensitive plays that are tied tangentially to the artificial intelligence plays, like power buildouts in the grid, so utilities come to mind. So I think there's a lot of opportunities for investors in cheaper parts of the market to start to lean into and rotate there and finally ditch cash, because cash unambiguously underperforms in all rate cutting cycles. And I think this should be the wake up call for investors to really do so if they haven't already.
Matt, we're looking at a picture of the dots, and the dots are all important, not just the 50 basis point rate reduction we had yesterday, but the 200 basis points down in the pipeline as well. What is that suggesting about economic weakness? Do you think we're likely to get 200 basis points more through to 2026, or is that going to be recalibrated again, to use Jay Powell's words?
Yeah, recalibration, Karen, was the word of the press conference yesterday. And I think we're going to see this gradual cutting pace. So I think it's been indicated you're probably going to get 25 more basis points at the next two meetings. I don't see why not. For the past three interactions we've had with Powell, he's talked about this being a process, not a one-time event. And so I think that's going to play out. You're going to see gradual cuts this year. You're going to see the gradual cuts next year play out, probably to the median of 100 or so basis points in 2025. And what's nice is that the Fed is in a place where they can do this. They don't have to do this. And I think that's a really important message to clients, is that what we saw with the 50 basis point start of this cycle is that it's not a harbinger of economic weakness. The economy is in a good enough place with inflation coming down rapidly. There's no need for the real rate of interest to be as restrictive as it has been. And so the Fed has the ability to do so. They took it. And I think that just signals that they want to make sure that the economy remains in a good place, which is why I think you can feel comfortable leaning into that cyclical trade more going forward into next year.
Matt, the problem is, and we all know this, they've done very well. Okay, great. Good mark for this one as well. But we know that central banks aren't very good at the medium-term stuff because things happen. Admittedly, some things they can't control, other things they can't spot for whatever reason. Is the crisis the next one? Or no, not next crisis, the next speed bump in this very smooth stick landing that you talked about from the Federal Reserve? Is it going to come from a recession or inflation or something else?
I mean, that's really the trillion-dollar question, I would say. It's what could an exogenous shock be? What are we going to have to contend with in the next year? And I don't think we really know. I think we know that based on what we're seeing today, things are moving in the right direction. But a key question could be, if rates start to come down, what does that do to the housing market, which has truly been an anomaly through this entire cycle? With rates moving higher, the housing market has held in there. With rates moving lower, could the housing market finally start to show some weakness as you get people to start moving from their house and more inventory comes on? I'm not inclined to say that's the case just because of structural imbalances that exist, but there's a lot of different things that could happen. And I think the key for investors is to keep your risk antennas up with respect to the fact that there are risks. We have never really been here before with respect to this unique situation we're in. But given the data that we have today, and really focusing on what's happening at the corporate level, what are management teams actually telling us are happening to their customers and their economies they exist in? And that story, at least right now, is confident. We're seeing management teams project confidence by and large about their businesses. And it just means own higher quality companies, own companies that feel good about their business moving forward, because that visibility I think we can count on, because management teams are paid to manage expectations and beat those expectations going forward.
Matt, so let's talk about the labour market, because this is the area that Jay Powell is now firmly focused on. He's switched attention away from inflation and is trying to salvage the labour market and ensure there's not too many casualties. The unemployment rate seen ending the year at 4.4% and remaining there through 2025. I wonder whether that's possible, because we've already seen this very swift unwind in the labour market, and there's been some concerns that that accelerates. And the reality is, even with a jumbo-sized reduction, that doesn't come through into the marketplace for quite some time. Do you think 4.4% is the level? Could there be more of an unwind? And what does that mean for consumption patterns, if so?
Yeah, Karen, that's a really good question. And I think when you look at the labor market right now, whether it's 4.4%, whether it maybe ticks up to 4.5 and comes back down a little bit, I think the labor market's in a good place today. And when you look historically at corporate margins being near record highs, I mean, the S&P 500 margin came in at 12.3% after second quarter earnings. That's very, very strong. You rarely, if ever, see mass layoffs when you have profitability margins as high as they are. And when I talk to a lot of management teams, I'm just not hearing them taking away jobs or taking away job openings because they might not need those extra workers, but they're finding ways to be more productive with the workers they have. And so I don't see any sort of large scale layoffs really coming down the pipeline based on what I've heard over the past couple of quarters. So I think the labor market can actually hold up in the coming year or so. And the labor market, like you mentioned, is the key. As long as consumers' wallets are going to be open, whether or not they're trading up or down, that's the fun part of what I get to do and trying to figure out where they're going to spend their money. But I think as long as that holds up, we can be confident that we're not going to descend into a deeper, dark recession because the labor market is the key at the end of the day.
I think also, well, there are many keys, I guess, as well, Matt. But I mean, we've had this election coming up as well. Let's be brutally honest, and we've heard from Ray Dalio again already on this channel today as well. No one's excited about the US debt profile going forward, and I mean especially the sovereign as well. Neither candidate looks like they're going to make any inroads into getting the deficit and the overall debt to GDP down. How much is that also a grave concern for the broader market?
So the U.S. elections are going to, I think, inject volatility into the markets over the next couple of months. The level of fiscal spending, I think the point at which we hit where that actually matters to the bond vigilantes, where you start to really get pushback, Steve, in the bond market, I think we're going to know it when we see it. We are not at that point yet. We can sustain a higher debt to GDP ratio. It doesn't mean that we should. I think what's most important, and I get a ton of questions from clients around what the presidential election means, how they should start to play it. I think number one is don't try and position based on who you think is going to win this election, because rarely, if ever, does what we think today actually play out going forward. And I think most important to this election is that we're likely going to end up with a divided government. So the party of the presidency likely isn't going to be the same across the House and the Senate. And what that should do is it should keep the worst ideas that both candidates have at bay. And so some of the biggest fiscal spending packages that we're talking about on the campaign road trail really should not come into legislation. And I think that's a good thing longer term down the road. So I think there's still more time before we get to that precipice where the mountain of debt that we have really begins to matter to the bond market.
Oh, Matt, it's a big day in the wash-up from the Fed. Thank you for staying up late for us. Matt Orton with us, Chief Market Strategist of Raymond James Investment Management. Fed Chair Jerome Powell played down the political implications of the rate cut coming less than 2 months before the US presidential election, saying the impact on the economy will take time to be felt. Reacting to the Fed decision, Democratic candidate Kamala Harris said the focus is now on keeping prices lower, while Republican candidate Donald Trump suggested the extent of the cut showed how bad the economy had become under the Biden administration. Speaking to CNBC, Ray Dalio accused both candidates of deepening the political divide in America, arguing the country needs a unifying force.
Neither is what the country needs. What the country needs is the moderates coming together to be able to work together and make great reforms. It needs a strong leader of the middle and to alienate the extremes.
US House Republicans voted against their own funding package. There you go. Leaving the US government on the path towards a shutdown just weeks before the US election. Republican House Speaker Mike Johnson has championed the bill, combining a 6-month funding stopgap with a controversial proposal requiring voters to show proof of citizenship when registering to vote. Arabile. I'll carry on for the moment. Coming up on the show, on the heels of the Fed's bumper rate cut, attention turns to the Bank of England, but expectations are somewhat more tempered. Well, Arabile will probably be with us to have a look at what we can expect out of Threadneedle Street. Plus, China ramps up efforts to come up with its own answer to Nvidia, but faces global challenges in the AI and semiconductor space. Our very own Arjun will also hopefully lay out the state of play. And we're going to hear exclusively, this one definitely will happen, I promise you, from the Iberdrola Executive Chairman Ignacio Galan. It's a beautiful backdrop there from the windy shores of Brittany. That's later this hour.
It is the big story today, but we've got our own central bank action this side of the pond today too. The Bank of England is due to make its latest rate decision in just under 6 hours. Arabile has more. Arabile, I thought it was fascinating. We saw the dollar sold off, then bounced back yesterday as the market then thought, well, what are other central banks going to do now that we've seen 50 basis point rate reduction from the Fed? Yeah,
so the Fed definitely not the only story in town, but it's certainly the one that may impact things quite significantly, because yesterday actually some of the probabilities changed quite significantly, and we'll unpack that in just a moment or two, because I think the Bank of England has got quite a lot to actually deal with when it comes to its decision today. Let's unpack first what we do know thus far, particularly on the data front. Yesterday, we got that CPI print then to have come out then from the ONS then that was. And that was really just painting the picture that inflation came out just above the target rate of 2%, so 2.2% on a year-on-year basis, 0.3% on a month-on-month basis. That was anticipated. That was the figure that was expected. Yes, core CPI went up to 3.6% from 3.3%. That may be an uptick to be concerned about. And you had services inflation, which is another aspect that the Bank of England has also been looking at, rising up to 5.6%. It was a little bit worrisome because it wasn't the 5.5 that the market is looking for, and it is an uptick from the 5.2%. And all these numbers are significant only because it signifies the uptick in this inflation print that may worry the Bank of England a little bit more. Now, let's remember that the Bank of England has said that they're going to remain a little bit more cautious when it comes to their interest rate path. They've already cut interest rates by 25 basis points in the 1st of August. But how much more is anticipated to be done then before the end of this year and into next year is going to be a key question. So what are the probabilities then of getting a 25 basis point cut then today? Well, pretty low. As you can tell there by your screen, as low as 18.8% then when it comes to that figure. And I just want to highlight that this figure was sitting at 35% as the chance of a rate cut then just yesterday. And now we're sitting at 18.8%. It does follow on from, of course, what we got out of the Fed yesterday, which was that bumper 50 basis point cut. But there are many aspects of this to really consider, because even if we find out then overall that the bank doesn't necessarily cut interest rates and decides actually that they're going to hold as expected, it could still be a pivotal meeting as it makes its annual decision on the pace, particularly of bond sales, or what is known as quantitative tightening. Now, the MPC voted initially to offload £100 billion in gilts this time last year, either through sales or letting them mature. But around £87 billion in gilts are due for redemption this year. That's way up on last year, and it only leaves only 13 billion for active sales compared to 50 billion that's last year. Now, analysts at Citi, Deutsche, as well as JP Morgan think the central bank could expand purchases to 120 billion pounds, and that's to try and keep some room then to maneuver. What are the political implications? Well, fiscal policy is going to be one to watch out for, because Chancellor Rachel Reeves prepares for her first budget then at the end of October. And if the Bank of England sells gilts at a loss, taxpayers make up the difference. And in March, the OBR forecast the lifetime net loss of this program at north of £100 billion. Now, speculation is growing that Reeves could change the way the country measures debt. So these losses don't show on the balance sheet until the Treasury pays the central bank, handing her an estimated £16 billion of extra headroom.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.